Good afternoon or good morning, everybody, and welcome to another Fintech Nexus webinar. My name is Peter Renton, Chairman and Co-founder of Fintech Nexus. Today, we are talking about the all-important topic of instant payments. Instant payments orchestration, an essential tool for lending and factoring, and really, it is becoming more and more important. I mean, if you want to go through any kind of process these days, consumers and small businesses are expecting things to happen instantly. And oftentimes we have instant approvals in lending, but not necessarily. And then the person might have to wait a couple of days. That just isn't a great experience. So it's becoming more and more important to basically implement instant payments into your operation. And we have an all-star team here with deep experience in fintech and instant payments, people that have gone through this process. So with that, I'm going to let them introduce themselves. Lydia, why don't we start with you?
Hi, everyone. I'm Lydia Imboden. I'm the Chief Revenue Officer at Ingo Payments.
Okay, Luke.
Yeah, hi, I'm Luke Boyles. I'm the CEO at Pipe.
And Chit.
Hi, I'm Anchit. I am the GM of Embedded Capital at Fundbox.
Okay, and Todd.
Hi, everybody. I'm Todd Ritterbush. I'm the president of TBK Bank.
All right. So let's get right into it then. I'm going to start with you, Lydia. Let's just talk about how a real-time payments program works. Let's just start with the basics and we'll go from there.
Yeah, I think the model's changed over time, and I would call it 8-ish years ago. It was all push to debit functionality, and that was kind of it if you wanted to achieve real-time payments, leveraging the Visa, MasterCard, and regional debit networks. Now we've kind of evolved into customer choice, and there are several different ways that you can fulfill instant payments as an endpoint. Whether it's push to card, real-time payments, Fed Now is the new hot thing, and issuing or instant issuing cards as well. And so typically picking a partner or building direct are your options. We can talk about that in a little bit.
Sure. So what I want to do to sort of get us going here is talk to the different companies on the call here who are in the process of or have implemented some instant payments, just to get their perspective. So maybe, Anchit, I'm going to start with you. Tell us, how are you using instant payments at Fundbox?
So at Fundbox, our mission is to provide credit as fast as possible to the underserved SMBs, and we typically take underwriting in 60 seconds. And for us, providing real-time payments so the customer can get the fund ASAP is important. Let's take an example, transportation. A trucker is on the road. They apply through mobile for the Fundbox application. They get approved, and they want to draw the funds immediately. For that, instant funding helps us, and we are using real-time payments as a backend to make it happen.
So is it an option for people? I mean, what percentage of the loans that you're doing today are flowing through instant payments?
So it's optional. So when people have to draw, they can choose whether they want to get funds within a minute or not. And in terms of usage, we have usage in the double digits. And for certain industries, it's 70% higher than the average.
Oh, okay. Okay, so Luke, what about at Pipe? How are you using instant payments there?
Yeah, I mean, the way to think about it for us is that we don't actually fund the advances with instant payments, but we are like a neobank in the background, right? So we actually get into the flow of money when a customer takes an advance from us. So they change their settlement account to a new Pipe FBO account, and therefore that lets us get into the flow of money. And so we use RTP to actually help them get their money faster, right? If like a Square customer takes an advance from us, for example, they change their Square deposit account to the Pipe layer. Square will do normally just ACH outbound, right? Not even same day ACH. And Pipe is able to instantly fund. When we see the Nacha file, we're able to instantly fund the money into the customer's account. So we either match the speed of payment, because if an RTP comes in from Square, then we can backstop it and match the RTP speed out. But our goal is to not slow down the money movement at all. They even make it faster, and we don't actually charge a fee for that. It's Square. So I led Square banking before.
Right.
Square charges now 1.75% fee to the customer to get their money faster. Right. So at Pipe, we're trying to make it free if we can, just to help the customers get their money faster. The number one pain point for small businesses is access to capital. Right. And like, they just need their money when they need it. If they need to make payroll, they need it now. And so we're able to basically, from a risk perspective, get into the right position, but then still help the customer get the money at the speed at which they expect to get the money. Right. Super important.
Right. For sure. For sure. Todd, what about a TBK bank?
Yeah, at TBK Bank, we have a traditional bank, which is taking advantage of the readily available instant payment services that our customers, more and more demand. That's just competitive necessity. But we also have a transportation-focused business, actually two of them. One is a factoring business and one is a payments fintech. And we're facilitating payments between shippers, brokers, factoring companies, and carriers. And with so many different levels of payment happening at different times, you can see how the delays associated with traditional payments could really stack up. So we're using instant payments to expedite the processing and flow of funds from all of those points to ultimately to the carriers.
Mm-hmm. Okay, interesting. Okay, so we heard a few different use cases there. So Lydia, why don't you sort of talk about when you're you've got lots of clients throughout the industry, what are the major use cases that you're seeing?
Yeah, so I think a few of them have been touched on so far, but on the consumer side, obviously personal lending, consumers are looking for instant access to funds. When we look at B2C disbursements, we work with really large insurers, top 5 insurers, looking to process claims in real time. But a big focus for us has been on the commercial lending space, and we're recently entering in the factoring space for access to capital, as Luke pointed out. It's like the number one reason that everybody is looking for customer choice. Today, we work with companies like On Deck. They've seen a significant increase in the number of drawdowns people have taken in their line of credit just because of the ease of access to those funds. And so I would say lending's probably the most prevalent right now, but looking to expand in the insurance space as well. Banks, treasury clients, looking to give access to their treasury clients as well.
Okay, so let's talk about implementation. And Anshid, I want to go back to you because I believe this was not that long ago that you went through this process. It's not a trivial process. So just tell us a little bit about how it went.
So I think we started this journey last year and we implemented it within 6 months. The few learnings that I had was like the most important, even though there's a need, the most important question when you are thinking of partnering with someone is not only with the vendor you're going to work with, but also their partner bank. Because it's a 3-way relationship and you need to know all the nuances. Another important thing is you also need to know the flow of funds very clearly from the beginning, and you need to have alignment before you start any execution. And the last thing is, as we do lending, in some states we have our bank partners. We also need to be cognizant of the fact of a 4-party relationship between Fundbox, vendor, our bank, and their bank. And how do you manage it together? So tech implementation, I think, is the easy part. Managing the other things is equally as important, and people should pay more attention to that.
Right. So how long did it take from beginning when you started sort of going down this process to actually doing live instant payments?
Yeah, for us, I think it was 6 months, and we had some competing priorities as well. But I think the tech implementation is not as hard. It's like aligning on the other things, which can take more time, and which is depending on each and every vendor.
Okay. And Luke, for you guys, when you have sort of like, what's it been like? How did that implementation kind of, because I imagine, I know you've only been in the job for a bit over a year, right? But was it happening before you arrived?
No, we didn't have RTP turned on or push to debit turned on when I got here. But I mean, we had a partner already for money movement. And so when I got to Pipe, one of the things we talked about and like aligned on with the product engineering team is that we don't actually need to build everything. Like we use a partner to do KYC, KYB, like it's an orchestration layer, right? We have another partner that moves money for us. And so we had already turned on the ACH money movement and had the bank approvals to do that. And so when we decided to turn on RTP, it took us less than a week, right? Everything was ready to go. We'd already done the API integration with that partner. And then to turn on a new money movement capability, it took less than a week. It was just to get the right approval and turn it on. For us, it's like for RTP, like just double check that the accepting or the bank we're pulling from or pushing to could accept that means, right? And just turn it on. And a little bit of work on our side, but it was pretty fast. And so I just take a strong view of like a lot of these infrastructure components should not be built by the fintech, right? It should be someone like an Ingo Money who specializes in that part that lets you then go super fast in whatever geo. So like we launched in the UK in 6 weeks because our KYC, KYB partner worked there and our money movement partner works there as well. And so it just takes those big regulatory and risk things off the table and you can just go super fast and like focus on stuff. So for me, these modules, like there's no reason to build a decision service or loan servicing. Like those modules you can just take and stitch together in an abstracted kind of orchestrated way, and it helps you go super fast. And so I would never, like at Square, like it took us, I want to say a year to turn on RTP because we were relying on the internal money movement team that had built everything from scratch. And it was just so much faster to go with like what Cash App did. They went with Modern Treasury because it was just faster to go move money than using the existing stack, right? And so it just helps you go way faster when you use a modularized component like this. Somebody who's an expert in that part, you can just go way faster.
Right. So Todd, then, I mean, is your instant payments system, is it live yet? I believe are you still in the testing phase? Is that correct?
That's right. We're in the testing phase for a new wallet that's geared towards carriers. We call it LoadPay. And LoadPay will leverage Ingo's push to debit capabilities in a couple of different ways. You could imagine that the carriers who are receiving funds from factoring companies and brokers want to get those funds as fast as possible. Today, when they need that speed, they're doing it through traditional wires. Obviously, that's not the best way to be doing things. So Ingo's push to debit capability is a nice alternative to that. We can, deliver value in a couple of different ways. If in fact the carrier needs the money right away, of course, we can charge a fee for that service that is less than what they pay for wires. If the carrier actually is fine with traditional ACH timing, we can also just delay the point at which we make payments and we capture the additional float that way. So a couple of different ways that you can take advantage of it. Once that money is in the wallet, then you've used the push to debit capability to move it from the carriers to others. It could be to their drivers, for example. And so now you've accelerated the payment from factors or brokers into the carrier's hands and then into the driver's hands. And all of those are opportunities for us to capture more value along the way.
Right. That's really interesting. Okay, so Lydia, when you're talking to like looking across the sort of your customer base, then what are some of the the timing and the considerations for putting this in? I mean, what is it? I mean, I imagine people don't say, "Oh, we don't need instant payments ever." It's a case, no one's really thinking that they can get away with that. But so, what are the the customers that you're working with that have implemented it? How long did it take, and what's the process like working with you guys?
Yeah, I think it kind of depends on the partner. We have several different integration options depending on if they're PCI compliant, they're not, if they need a way to bring the customer into the experience for them to tell them how they want to get paid. And so it could be an API or an iframe or what we call our customer engagement platform that will kind of bring that customer in to tell the business, how they want to get paid and how they want to receive their funds. That's all vary based on, timeline. I would say our average integration is probably 4 to 5 months. If you're on the customer engagement side, which is mostly where we focus in insurance with our large treasury banks, that's probably more of a 6 to 8 month process. It's fully customized and white labeled for the partner. So nobody really knows. The customer doesn't know it's in go at all. We're sitting behind the scenes. But I think what Luke was saying around orchestration is really important. We've been doing this 10 years. We started out using these push to debit transactions for our own direct to consumer business, and then kind of pivoted when we realized the whole market is moving to instant. People want to get paid the way they pay merchants, and to your point, there's no one's asking when am I going to move to instant? Everybody's there. Now it's how. So the ways that, we would leverage that, you want to look at partners that manage their own routing. Do they have one integration into a network and that's what they're leveraging? You're not going to have a ton of coverage there. Do they have RTP and FedNow and redundancy if the, consumer or the business doesn't have a debit card to plug in? Do they have a PayPal account or a wallet account? You want to look at that optionality as well. And it would take a lot to go and build all of those direct integrations. I would take a lot to manage a bank sponsorship or BIN sponsorship relationship for all of those integrations. And so you really do slow down time to market. So to Luke's point, like leveraging a partner for speed is key.
Right. Okay. So I want to talk about the challenges here that need to be overcome because, as I said, it's not a trivial process. But what maybe, Anshit, it'd be great to get your perspective here, having just recently gone through it. Knowing what you know now, I mean, you obviously overcome all the challenges, but what were the biggest stumbling blocks or things that had to be overcome along the way?
I think the biggest challenge for us was, I think, aligning our banking partner with our vendor's banking partner and speeding that up. And we are an engineering driven organization, we ship things quickly. And when we do that, we typically want that to be the last bottleneck rather than anything else. So yeah, I think that was one learning which everybody should think through proactively when they're prioritizing resources. And the second thing I'll say is also the coverage, because we try to serve the underserved, and sometimes a lot of small banks might not be covered even by the real-time payments. The coverage is not 100%, and it's not fair. If a small business wants to use it and cannot use it.
Yep. So what do you do in that situation where the small businesses bank is not part of RTP, is not part of, and they don't have a debit card? What do you do?
Yeah. So now, as we have seen the adoption very well, and a lot of small business want it, we need to be, if it means RTP, push to debit, FedNow all together, if it means partnering with multiple vendors, we are open to all that to make sure we close that gap. So yeah, we plan to invest a lot here.
Okay. So Todd, I want to go back to the digital wallet that you talked about, because that seems like a really interesting use case, because feels like wallets are becoming a bigger part of the fintech landscape, shall we say. What can you just maybe take us through the process there about exactly how you're integrating instant payments with the wallet? I know you touched on it earlier, but maybe just go a little bit deeper.
Yeah, so of course, there are a lot of wallets out there, and a lot of wallets, they're catered to different audiences. In our case, we're catering our audience to a small trucking company. So this company may have only one driver and one truck, or maybe has 4 or 5 drivers, 5 trucks. And the way that money moves to and from carriers is unique relative to other businesses. And so, we had to start with understanding how these carriers operate every day on the road. And you can imagine it, these are businesses that are truly mobile. The owner of the business is often far away from home, and they're needing to transact business. And when they're on the road and they need cash, it's usually because, something has gone wrong. There's equipment that's failed and repairs that are needed, or something like that. And so, you start with the customer experience you want to deliver, and then these use cases for immediate or instant payments and the push to debit type capability jump out at you. You're like, okay, so now I can relate to what this carrier is experiencing. What's the best way to solve this problem? You pretty quickly realize that the traditional payment methods just don't work, or at least they don't work anywhere near well enough, and they cost a lot of time and money for the carrier. So now you start designing a wallet around what are all the on-ramps that you need into the wallet, what are all the off-ramps you need off of the wallet, and these types of payment capabilities, again, jump to the forefront. So then you begin the process then actually working with the partners that can deliver these capabilities to you. And for us, that was actually, a very new venture for us. We work with a lot of vendors at the bank, but we've never dealt with so many different new third parties at once. And so our whole process of vendor evaluation, negotiation, and onboarding was ramped up in a way that we've never ramped up before. Concurrently, we had to also, think about compliance and apply what we knew, but also absorb new lessons much faster than we ever had before. And, we started with this mindset towards, like a lot of smaller banks, thinking about real-time payments, and then dealing with the reality of how long that would take, what other partners would be involved to get that going, and then realized that for us, the best way to go was with Ingo to get started. That was, as was described earlier, just the fastest, easiest solution for us.
Yeah. Okay, so Luke, I know you guys are working with a lot of like vertical SaaS companies these days, and you're onboarding these are technology companies, right? So how do you talk about instant payments right off the bat? I mean, what's their kind of what's sort of the market talking about right now when it comes to disbursement of funds?
Yeah, I mean, the customers are asking for it. They want their money now. Pipe is about to build a card product with spend management and bill pay. We're going to have an auto savings for tax feature. We'll have a full wallet. We're going to have payroll, right? Like all of those have very specific use cases around instant money movement, right? I think it's worth talking about risk for a minute, right? Like the money in and money out, like moving faster. Like there's good and bad. So let's talk about payroll first. Like ACH risk is real. Like you pull the money, you send the notch file to pull the money from the employer's account on payroll, and then you fund the employees. You're funding the employee out of your own bank account. You don't know whether the money got there or not. So ACH has real negative risk implications, especially for something like payroll, where if that money returns 3 days later from the employer, you've already funded the employee with your own good funds, right? And so then it's like a 2-day loan over the weekend or whenever you're funding payroll. And so RTP or real-time payments or FedNow, like there's a real opportunity to solve the same-day payroll problem with just confirmation that the money got to where it was supposed to be, right? You can't get confirmation with ACH. Like that's the biggest pain point of loan servicing as well. Like you try to take a payment and it didn't work, and you retried it and you get an ACH return like 2 days later, 3 days later, 7 days later. The retries like the edge cases are enormous. So the not just instant, but confirmation that the money is going to stay there is the other magical thing of RTP and of like push to debit as well. You know that the money's there and it's not going away. That's one piece that's good. The negative risk side, though, is that when you're a payments business and you're accepting payments for a trucker and you have a wallet and it comes in, if you start to instantly let that money go out the door, you have to get to a real-time risk decision engine, right? Normally you have a batch process, the money comes in, you can sit on it for 2 days to wait to make sure the ACH doesn't return. You can then ACH it out when you feel good about it. But if you move into a world where it's instant out, the risk is 100 times harder because the fraudsters will come after the instant money out. Like put the money on a debit card and spend it now, instantly push it out to the other bank account so they can get it out of the system. Like that, you become a real fraud vector or fraud target when you have instant money out. So at Square, for example, all the bad guys came after Square Banking because that was the fastest way to get the money out. Right. And so like that is the hardest problem. If you don't have a real-time decision service that can tell you which customers to green light and let the money go and which ones to hold up, you could lose a lot of money. So there are good risk things and there are bad risk things, but like instant money movement across the board, like it depends on what the partner has, right? If we talk to a SaaS vertical business that's been laser focused on a single industry, they may not have a wallet yet. They may not have any of the embedded financial services yet. We'll start with capital. We'll turn on our spend mechanisms and our auto savings. We can actually give the partner all of those things, including instant money out. If a customer still wants to use their outside bank account, that's great. You can have the money come in. You can the savings can be a secondary feature. We can hold our payment for the loans and then just give them the rest of the money in their like TBK bank account if they want, right, on the outside, and not try to take the primary checking account. So we have a full menu of stuff that the SaaS vertical partners can decide to turn on or off depending on what we have launched. Many of them love the RTP, like instant money out. Like, can we do instant money out for our customers at the same time as onboarding for the loan product? And the answer is yes. We can actually make it automatic. When the money comes in, we can RTP every single time. We just need to figure out how to cover the cost, like very small costs from like 12 cents per transaction or less, right? If you get it negotiated the right way. If the partner wants to cover that, or even maybe charge 25 basis points or 50 basis points to get the money faster to the outside business, that's okay too. But for me, like risk is the most important piece, right? Yes, you can offer the features, but if you can't control the leakage from fraud, you should not move money instantly. You need to be able to control that.
Yeah, and just to build on the point that Luke made very well, he articulated the sorts of conversations all of us would be expecting to have in our day-to-day jobs. But the surprise to me has been that our clients, these carriers, they recognize this risk too. They deal with fraud every day themselves. And so they have to be convinced that the way we're doing this is safe for them. And it's not good enough just to say, well, we'll absorb the risk for you. Like they want to actually just know that we've set this up to be successful. And so I wish we had, Luke to articulate all this to our clients for us. That'd be great.
I'm a little busy with Pipe, but yes, happy to help.
Okay. So just for the audience, if you have a question for our esteemed panelists, hit the Q&A button. We're going to go get to those questions later in the hour. But I want to talk first now about fee structure and what kind of fee structure works best. Who has thoughts on that? I'll just call on you if you're not going to volunteer.
I can speak to it. So a lot of many of Stripe and Square and PayPal and other like Toast and others are charging the business for this, right? A point to a point and a half to 1.75% to get the money out instantly. So the way it would normally work at Square, for example, or a Stripe is that the payment processor, so the customer comes to the coffee shop and swipes a card. The money the processor handles it, deposits it into the like software company's bank account, and then they ACH it out. And so it can take 2 days or 3 days or 5 days for the customer to ever ultimately get to use that money. Because the bank, because of the risk I just talked about, will sit on that ACH for 3 days before they let the customer use the money. Chime, interestingly, allowed instant release of the money into their own account by just when they see the notcha file and they know that ADP or whoever the employer is that wrote the check, they just take that ACH risk. And that's what that drove so much of Chime's growth, because they just did like 2-day early wage access by just gaming in the ACH system. And so like a lot of these businesses use it as a revenue line item. It was a big revenue line item for Square Banking to have instant transfer, because the companies that need their money need it now, right? It's not just the small businesses, it's the larger businesses too. The utilization across the board was in the like 20% range for even larger businesses, because there's just a moment where if you just mess up your working capital timing, that you need money to pay payroll now. Even if you have 50 employees, sometimes something happens with money transfers out of your control, that you just need to get that day's transactions in so you can fund payroll, right? So there's a huge demand for it because it creates so much extra risk. It justifies like having some fee to get that money out faster, because you have to control for the risk. When you turn it on for the 10 good customers, there's 10 bad customers coming to try to get you. So like it actually is, the unit economics of the money out have to work. So I think it is okay to charge a fee. I don't know how high that fee should be. It's completely inelastic, right? When the customer needs the money now, they're going to pay 1.5 now to get it. They pay 2, they pay 3. People pay $3 to get their money out of the ATM when they're just taking $100 withdrawal. They want the money, right? Like that. This is where I don't know what the right level is. Like you need to keep it as friendly as possible and not use it to gouge people, is my view. Like Pipe would like to make it free. We just want to make instant money movement part of the playbook without charging for it. But many of our competitors, like the larger ones, are using it as a revenue line item right now.
Yeah, I think it's also important to keep in mind what service is being replaced by the instant payment. And so, using the example of the factoring company making a payment to a carrier, if that factoring company is asked to make the payment via wire today, of course, they're passing along the cost of the wire, plus they're marking it up. So they view that as a profit center. So they might charge, I don't know, twice as much as the wire is actually costing them. So that's their starting point. They're our client. They want to make sure that they preserve at least as much margin as they had on the wire. And candidly, they may even decide they want to charge more than that, because they can charge more than that and still charge the end customer overall less for the transaction. So their mindset is always going to be around, where are they starting from? For us, when we're using instant payments to put money into the wallet, I'll use the example of when we do advances. So this is actually a credit product. You're seeing out there that a load is tendered, and so we know that a carrier is carrying a load for someone and we'll be paid for it, and so we can give them an advance on that. When we do that, what we're going to charge for is for a fee for the credit, which will absorb the cost of the transaction. We're not going to have a separate charge for the instant payment in that case. That just becomes part of the overall value of the advance. So, I think it all depends on where you're coming from and what the value is to the customer.
Anshit, what's Fundbox's
I think our philosophy here is we should give customers the option whether they want to use it and price accordingly. And the pricing again goes from a point of view of the operational cost of doing this, as well as the risk. And the risk is combined both third-party risk, which you can control if you have strong systems in your place, like two-factor authentication so that nobody else can access. And the second thing is the first-party risk, where we as a lender already have models. So we make sure that we only give this for the people we believe we can justify the risk and price accordingly.
So Lydia, is pricing all over the map still? Is there becoming any kind of industry standard, or what are you seeing?
Yeah, candidly, I kind of see it vertical by vertical shift. The strategy is very different. I would say on the commercial lending side, I do see, and any company that's offering a wallet solution is kind of mimicking the PayPal and the Venmos of the world, charging for access to funds instantly, or giving that free option if you want slower funds. You're paying a premium for speed. I would say when you're looking at more B2C disbursements or treasury banks, are typically not charging those funds because they're making their money on other pieces of that journey. And they're just trying to get instant access, or instant availability for that consumer for, customer satisfaction more so than that being, a revenue stream. But honestly, yeah, it's kind of all over the map, and it varies by vertical.
Okay, so I mean, we've touched on risk, but I want to talk about compliance for just a minute. Like, what are the compliance issues here that that people need to be aware of?
I'm happy to start again too here. Like the real risk is AML and like money laundering type stuff, right? Where you become a target for fraudsters, you need to have a stepped up ability to detect when bad guys are trying to use your rails to move money, right? With ACH, you have more time again to do that KYC, KYB, BSA policy application, to make sure you feel good that you know who these people are before you start moving money for them. I think Anshit mentioned like an account takeover risk as well. If a bad guy can take over the account of a good guy and then use it to route money, that's also an AML problem, or could be a terrorism problem as well, right? And so you have to have faster systems that can detect if there's a shift, and you have to have real-time transaction monitoring from an AML perspective to know like whether these things should be stopped on the way out. You can have a batch compliance process that does some monitoring, but that'll never be good enough to stop the real-time money movement out if you detect a bad guy, right? And so it is KYC, KYB, AML. It's being able to do that faster the right way and stopping the funds if you can, right? It's a big deal. Like, yes, you can file a SAR later and then turn it off and try to figure it out, but like the better thing to do is just stop it before it happens. And very few companies have real time like the ability to turn on and off like money movement from transaction monitoring on the compliance side. Like, to be best in class, you actually need that. And I don't know how many banks even have that, honestly. Like, it's pretty modern tech to be able to build a compliance system like a real-time like fraud system. Like, nobody's really doing it yet, and Pipe's trying to actually.
Yeah, so our core systems provider doesn't have a solution that accomplishes what Luke was describing. So that forced us to begin evaluating third parties. And so then you look at what the third party alternatives are. And if we were to go back a year ago, their offerings we didn't feel were sufficient to meet the expectations of our overseers. So we were pausing to continue to evaluate until we felt someone was able to provide this ability. And if we were going to launch anything before that, we were going to have to do a whole bunch of our own manual work in the background. So the good news is that some of these third parties have really come a long way in the last year, and it's easier to get much more comfortable today with their capabilities. They also have more of a track record, more clients and all that. So that makes us feel a lot better. But that third-party risk management component is obviously essential, and I think you're probably going to get to this, but in the world of BaaS backlash, everybody's concerned about third parties now, and so there's just that much more focus on it.
Yeah, let's go there then. It's very much in the news. It's an ongoing crisis, shall we say, certainly for some of the fintech customers that have had their funds frozen, but what has this changed, like the BaaS kind of blowback right now that we're seeing, and obviously there's a finite number of fintechs and a finite number of partner banks that are involved, but has that sort of impacted anyone's thinking around instant payments?
Yes, like if you give something a benefit of feature, and if there's something low probability and high impact event happens, it can impact a lot on the customer experience. For example, like if Amazon is giving 1-day delivery and they cannot do it and they will take 7 days because of something happening, that will be bad experience. So I think from my vantage point of view, you need to work with multiple players to make sure you always have a fallback option.
Yeah, and I would build on that as well. I think what we're seeing in our industry is at one point, fintechs or businesses have been separated from bank sponsors and bank partners. And I don't think that we can really continue to operate that way. And so really encouraging banks and technology partners and fintechs to all have individual direct relationships is key. And then also, to Anchit's point, having, you know, some redundancy and some variability from a risk perspective with those bank sponsors for those various fintechs. So we work from, you know, smaller community banks and fintech banks all the way up to large treasury banks like Key, who are, you know, 190 billion in assets. And so I think just from a risk perspective, making sure that you pick a partner who has, you know, a lot more redundancy around partnership will continue to support you long-term as you scale and make sure you don't run into any roadblocks later.
Right. That's a very, very good point. So then, Lydia, just staying with that, then, you know, I'd like to give you an opportunity here to sort of expand on that, like working with someone, you know, like Ingo Payments. I mean, there are companies you can build this yourself. Luke talked about Squared building all these capabilities themselves. But what is the real, like, why is it better to work with Ingo Payments than doing it yourself?
Yeah, I think there's, you know, a few different reasons. Speed to market is probably most prominent, right? Like if you were to go and build, you know, each integration to every network that you need, every wallet that you need, you're signing up for, you know, all the third parties from a risk perspective that we touched on. We leverage a ton of different third parties for risk mitigation, looking at device fingerprinting as an example, right? All like layered into our entire experience. So for a partner of ours, they just see one API and they get every endpoint. Think of it as a subway system, right? You get every endpoint that you're trying to hit, along with the risk and compliance, you know, partners embedded into that, and a bank sponsor. So you're not spending probably 2 to 4 years in BD and signing up for a bunch of minimums and trying to piece together all of that. And then honestly, the routing, I would say, is probably the most key. We've been doing this for 10 years. And, you know, a friend of mine once said, experience is what you get when you don't get what you want. So a lot of trial and error early in the market before these issuers started participating and turning on fast funds for their cards. We quickly realized, okay, a transaction to this financial institution of this size will work on this network, but not this network. And so we can hit every card, I say every card, 99.9% of cards in market, you know, the first time versus having, you know, 4 or 5 different retries because we're not sure where we can route it because we manage those bin tables. You know, if you were to build that yourself, again, that's like 10 years of experience. So do not recommend it.
Okay.
Can I pile on the BaaS question?
Yeah.
I have thoughts.
Okay.
So on that one, like we saw it coming when I was at Square before I even joined Pipe more than a year ago. And so we very carefully picked a bank partner that we would face directly, right? Yes, there is a technology partner in the mix that has the direct integrations with the Fed and Visa and MasterCard, but they are the vendor of the bank. And we are a like contracted entity of the bank separately. Like we are directly there. They happen to use that tech partner. We also use that tech partner to call those APIs to do the BaaS layer components. The bank can look over our shoulder real time through Alloy, our layer that lets it, like our KYC, KYB engine. They have control over rule changes. Like they can monitor us real time as things are going on as we apply their BSA policy. There is the right way to do this, and Pipe has done that on the BaaS side. This whole intermediated model where the fintech, like the BaaS layer in between was trying to do everything for you is going to go away. It's been on the path of going away for a long time. Like I got to hear Helena McWilliams speak at the Bain NICA CEO Summit actually, and she had pretty strong thoughts here too, by the way. She's ex-FDIC head. Right. But it was very interesting. But if you shift now to okay, let's just move money instantly, you don't have to have a full BaaS bank setup, right? We can work with, like, I'll just use an example. Like, we have money at HSBC and we have money at JP Morgan. That is just the pipe treasury account. Like, our CFO puts the money we have on balance sheet into a bank account. And when we fund an advance, we do it by calling an API of our money movement partner to tell the bank to send money. So we had a previous existing relationship with the biggest banks because we have millions in deposits already. And all we're doing is using a technology partner to tell the bank where to move the money and when. And the bank has to do an integration separately with that money movement partner. And so if you start with the bank relationship, you're already approved. Then moving it from a daily Nacha file paper setup to a actual API setup is not that hard if the money movement partner you work with already has an integration with that bank, or we'll put it on the roadmap to do the integration with that bank. And it's the same in every geo. Like, we launched in the UK with HSBC. We already had a relationship in the US. It was quick to get us approved in the UK. And the same money movement partner already was able to do the APIs, and we were able to fund loans very quickly. And so it's a very different type of setup. It's really like the way we move money, it's out of pipes accounts. And so you think about it from a treasury perspective, it's different than the BaaS setup, and it's actually safer, right? So I don't think there's any risk or pressure right now on that specific money movement setup, because we face JP Morgan and HSBC directly, and they're just moving our money based on our direction like any bank would. You don't have to go in and do a deposit statement anymore. It's all APIs, but very different setup, actually.
So we're coming up on a year since FedNow launched, which, and they've got a number of, I know it's over 500 now banks on board, and that number's growing almost every day. And then we've had RTP around for many years. But and FedNow obviously run by the government. Do you think what do you guys think about sort of FedNow, and maybe to a lesser extent the growth of RTP, and how that might eventually change things for instant payments?
Happy to jump in there. Yeah. So I think, we have a ways to go for adoption. It's people are talking about it. It's the hot thing right now, in addition to RTP. I think it's honestly just, another endpoint that you're going to have. Today, we, collect credentials, and we will try and route it via FedNow or RTP first. But if that financial institution isn't supporting those transactions, we have a way to default over to same day CH or ACH, and the customer just kind of adjusts messaging there. But yeah, we're seeing, the request, but it's not necessarily being prioritized, because I think everybody thinks we have a couple of years before adoption's really there.
Yeah. But are you processing FedNow to FedNow, like two banks with both FedNow? Are you processing those today?
We're stood up, yes, but we haven't had clients say turn it on yet, because they're worried about customer experience. Yeah.
That's what I keep hearing. It's
ultimately we expect to use both, but with other alternatives available that deliver much of the value that they offer, our sense of urgency around it is not as high as it would have been in the past. And the long-term value proposition of having both isn't really clear to me. I mean, I think for the time being, there's a bit of a differentiation between the two, but over the long term, it's hard to see why my clients really need us to have both, but we will.
Right.
So.
There's something interesting about the history of Nacha and the clearinghouse, and what the regulators actually have the right to do here, that kind of dictates all this stuff. Like, the way Nacha works is just an organization that created a standard file type that could be faxed, and all the banks signed up for it voluntarily, right? Because it made it easier for them to move money, and now all this money moves on ACH. RTP was the clearinghouse banks getting together to move money rapidly using the same architecture and infrastructure and APIs and standardization to make it easy for all those banks. So they got a big head start. FedNow, there's not a standard API. Like if I go integrate with TBK or Chase or HSBC, they can just make up whatever API they want for us to go like integrate with, for them to then do whatever integration they're doing with the Fed in the background. There's no standards body. The banks have no incentive to make it a standard thing because they want to push RTP instead. And so it's going to get lost because the Fed doesn't have the right to mandate a new like money movement, instant money movement use case. And so there's a real regulatory reason why I don't see Fed now going anywhere, because there's not enough momentum or incentive alignment behind it to make it happen.
And they've done it differently. Like that's like when you've got Brazil and India that both mandated
100%.
That's why it's just exploded in
yep.
in those countries. Okay, let's go to audience questions. We got a few. If you this is now the time to put it in if you want to get your question answered. First one first one here is, speed to be paid or pay has its limits. Where does it stop being relevant? I.e., paid in 5 seconds, paid in an hour. What is the speed that should be that should be considered when you're talking about instant payments?
I always go back to the customer. Like, what does the business owner want, right? I have to pay payroll today. I realize that I might not have enough money. Like, I think the range is I have to be able to get the money and use it now, today, but before the ACH cutoff, likely. And so if you're 30 seconds away from the ACH cutoff, then you need it now, right? You can't do, like, many payroll businesses won't do same day payroll. You need it like 3 days before you actually need to make payroll and have it there. So the money's coming out in the right way. So like, for me, it's like, it has to be as fast as they need the money is the answer. And so 5 seconds, an hour, 2 hours, who knows? But this tech is within seconds, right? It's pretty fast. The question is, do the risk engines on the other side allow the release of the money, right? And most on RTP, they just let it go because they know they have it, right? There's no way it returns. That's how I think about it.
Yeah, and I think, beyond the real need for the money to be available instantly, there is value in the minds of some consumers just to see that it's there instantly, not to have to wait even a few minutes. And so that may diminish over time as people trust in a different way. But for the time being, that ability to show that it's available right now when you collect actually does have some value.
Exactly, to Todd's point, like if I'm paying money for something, if I open my bank account, it should be there.
So very, very quickly. Okay. We need instant payments capability. Does it matter much on which payment rails instant payments are provided?
Yeah, I think, kind of touching on the same question, I don't know that the consumer understands the difference, right? They just understand instant. And that's where customer choice kind of comes into play, and having redundant options, whether it's offering, RTP, maybe Fed now, same day ACH, push to debit, PayPal, etc. Giving the customer the choice, I think is key there.
I think it's worth highlighting the experience difference as well. Like to use push to debit, you actually have to have the debit card number. To use RTP, you need the ACH and routing number. Most folks will already have the ACH and routing. And so it's a much smoother experience for the underlying customer to say, hey, we already have your information on file. We can go ahead and do RTP and push it to you now. If you want to do push to debit, you actually have to have a reason to get the debit card number to use the actual interchange rails to move that money instantly. And that's a pretty big blocker for a lot of folks. So you have to ask for it in the application if you want to turn that on. That's the big disadvantage that Visa and MasterCard have, is that like it's a whole different routing, like it's a whole different thing than the base number you use to connect to accounts. You have to have a debit card too. And so RTP has a huge advantage because of that, actually.
Okay. What this one maybe. How do you offer customers a choice over a number of different payments channels? Or I guess the question should be, do you offer customers choice?
The easiest thing to do here is like, think about the balances page at Square, right? The Square banking team controlled those pixels. The business owner comes to see how many credit cards their coffee shop processed today, and they'll see how much money is going to be deposited in their TBK bank account at the end of the day through ACH. That's where you give them the choice. Here's your money. It's coming. It's going to be there for your use in 3 to 5 days. If you'd like it faster, you can pay this fee to get it faster. Or if you need even more than that, you can take a loan right now, and we'll fund that like by tonight as well if you need it now, right? So like you have to be at the point of pain to where the customer knows they can get money faster. And so usually that's the payments dashboard with wherever you are. Right. I think that for Todd's customers too, they're coming in to see like what stuff's coming in. Like I need like when the CFO looks, or the treasurer looks, or the accountant looks, or just the business owner looks, how much money am I getting and when, and do I need it faster? So you have to have a UI or location like the payments dashboard is the best place for that, to give them that choice. So yes.
And in terms of who wants the choice, my experience, and this could be different in different cases, the payers usually want their choice more than the payees. The payees don't typically necessarily care as much how they're paid. They just want to be paid right away. The payors tend to have habits, preferences, a favorite.
And many of them like checks because it takes a long time to get that money out of their account, right?
Right. Okay. So I want to talk about the looking for the future. As we talked about, like we're not going to go back to slower payments. We're on it. It's a one-way street. What we're on here towards instant payments, instant disbursements. What does the future hold when it comes to instant disbursements and the increasing expectations around real-time payments? I want to hear from everyone on this.
I think from my point of view, like with capital, the context in which it's provided is so important. And once this capability is being adopted, the context in which it's given, the user experience around it will matter. Like somebody using it for payroll is very different from a trucker using it in the use case. Same thing with a subcontractor in the construction industry. So like thinking clearly around the user experience around that will be where a lot of time will be spent here.
Okay. Todd?
I think Anchit said that perfectly. I don't have anything to add to that.
Okay. Okay, Luke?
Yeah, I mean, I think people have to see what it's like to get money faster, and then the expectation is automatically there. Every W-2 employee in the United States is trained to get their money every 2 weeks. Why? Like it should happen instantly. Like every hour you work, you should be able to get your money, right? So I think Chime showed how powerful just 2-day early access can be without really taking any risk or doing a wage advance, just compressing the money movement time frame. When an employee, like a driver for Uber now, can do a ride and then instantly use the money from that ride to buy gas for the next ride. Like you just have to see it happen once, and then your expectation is like, why is this taking so long? Like, what the heck is Nacha? Like nobody knows what that is. That's what slows everything down. But as soon as they see the instantaneous transfer, they see it with Zelle, they see it with like Venmo and moving money instantly between consumers. Like once you start to see that it's possible, then you're like, why is my bank sitting on this money for so long? That's not fair. I want to go to a bank that can actually give me the money movement faster. It is going to be a core strategic advantage of the financial services system to be able to, for free, instantly move money, right? That's where the expectation is headed. For me, like if you're just not used to seeing money move fast, you won't even know that it's possible. You just get used to slow money, and then that's it. Like most W-2 employees, I think it's just like you got to see it happen. You're like, wow, like why can't? Or anyone who's been in India and seen like how fast money movement works, or in Brazil, like that the whole cultures have seen it. And like, what's wrong with the U.S.? Why is it taking so long? It's crazy.
Yeah, I mean, I think Luke hits the banking mindset spot on there. The way bankers think about float and the value they ascribe to float is huge. And being willing to accept that the right thing to do is to speed the velocity at which funds flow and not try to, greedily hold on to that flow it's a big change in mindset for most bank managers. we've got to get over it and realize there are other ways to derive value from our relationships with our clients.
Right, and it's even more so
And
with
the
interest
thing
rates
that's
where they
going
are
to wake the
today.
banks up. Well, the thing that's going to wake the banks up is when they start losing customers. People start to shift their primary checking account, either on the consumer or small business side. They'll say, "Oh crap! Like we have to actually match that speed," or it's that is a big enough benefit for people to actually change their bank account for the first time, because nobody changes usually. But if you have the magic of instant money movement, maybe you will, and that'll force all the banks to wake up.
It's so funny. I had a conversation with a 70-year-old relative in the last week. And he's like, "What is fintech? What do you do?" And we all love that conversation, trying to explain what we all do. And he's like, "Oh, like Chime." And I said, "Yes, exactly, like Chime." He goes, "Oh, I actually just moved. I banked with Wells for 20 years, and I just moved off Wells to Chime, because of Dallas Mavericks, go Mavs, but also because they're giving me my social security check 2 days early." And he's like, "That's why I moved." And it's so funny because to me, and I don't know if the same is for the rest of all of you, but I would so much associate like Generation Instant with, the millennials and the younger generations, but seeing, a 7-year-old relative say, "No, I want my money instantly too." I think Luke, spot on. Like Todd, same thing, where we've all arrived. We all want our money the same way we pay everybody else, billers, merchants, et cetera. They all expect us to pay in real time. And now we have that same expectation when we're owed money.
Well, that's a good place to end it on. So thank you very much, everybody. Thank you, of course, to Ingo Payments for sponsoring this webinar. Thank you, Luke and Todd and Lydia, for your insightful commentary. And of course, thank you to the viewers for tuning in. Appreciate everything, and have a great afternoon, everybody. See ya.